Welcome to This Explainer. We're diving straight into a structural teardown of a truly fascinating company today. We're looking at the anatomy of a turnaround. Specifically, we're putting Lyft under the microscope to chart its very complex but definitely possible road to profitability.
So let's kick things off with the massive question investors have literally been asking for years. Is a company with a huge footprint but a distant second-place market share a value trap, or is it a hidden gem? Right now, Lyft is locked in this intense, high-stakes battle against a totally dominant rival, Uber. The financial stakes are astronomically high, and the mobility market is shifting right beneath their wheels. Today, we're going to figure out exactly what's going on under the hood.
Here's the roadmap for our anatomy of a turnaround. 1. We'll look at Lyft's mobility marketplace engine. 2. Navigating the road ahead. 3. The turnaround architect. 4. Calculating intrinsic value. And finally, 5. Trading the trend.
All right, Section 1, Lyft's mobility marketplace engine.
Think of this business like inspecting a car, right? You got to start with the engine. And the core mechanics here are actually brilliantly simple. It's a classic two-sided mobility marketplace. Step 1, you, the rider, send a request. Step 2, Lyft's platform acts as the matching and pricing engine. And Step 3, the drivers and fleets get dispatched. But here's the absolute crucial point. Unlike Uber, which is trying to build this massive global super app with food delivery and freight and everything else, Lyft is hyper-focused. They are heavily concentrated purely on the North American urban mobility ecosystem.
Now, this asset-light model generates cash mostly through take rates. Basically, they grab roughly 20 to 30% of every completed fare. Toss in fixed platform fees and dynamic surge pricing when demand is hot, and you got the basics. But the turnaround, that really gets its fuel from recurring revenue. Think Lyft Pink subscriptions, micro-mobility rentals like e-bikes, and this is huge, highly lucrative non-fare revenue through Lyft Media and in-app ads. These are high-margin segments explicitly designed to offset the heavy costs of their core rideshare business. Moving on to Section 2, navigating the road ahead.
Let's map this out with a quick SWOT analysis. Lyft's primary strengths are that focused regional scale and the asset-light model we just talked about. But, that regional focus is kind of a double-edged sword. It means geographic concentration, which leaves them vulnerable to U.S. economic cycles. Plus, their scale disadvantage compared to Uber just means less dynamic pricing flexibility. Oh, and high commercial auto insurance premiums, that is a massive structural drag on their margins. Looking at external threats, we've got constant margin price wars and the looming disruption of autonomous vehicles, or AVs, from players like Waymo, Zoox, and Cruise. Like, will driverless fleets just bypass Lyft entirely? Well, that actually leads directly to their biggest opportunity. If Lyft can position its routing network as the commercial fleet dispatcher for those exact same AV partners, turning a massive threat into a turnkey B2B operation, that completely changes their trajectory.
Which brings us to Section 3, the turnaround architect.
Every turnaround vehicle needs a skilled driver. In 2023, David Risher took the helm as CEO, and honestly, his pedigree speaks for itself. After Princeton, he spent the 90s as a general manager at Microsoft. Then, in 97, he became Amazon's first VP of product and store development. He literally helped scale their retail revenue from $15 million to over $4 billion. Let that sink in. After Amazon, he co-founded WorldReader, a global nonprofit that reached over 21 million readers. So Risher brings 3 solid decades of experience in scaling massive tech ecosystems and driving serious operational discipline.
And you don't even have to guess his management ethos. He says it right here. The competitive spirit I learned at Microsoft, the customer obsession I learned at Amazon, and the do more with less lessons I learned leading WorldReader. That right there, that's his explicit mandate for Lyft. He's translating that Amazon customer obsession into driver earnings transparency and app simplicity. And that WorldReader do more with less attitude, that's turning into aggressive cost reduction and better platform liquidity to finally close the gap with Uber.
All right, Section 4, calculating intrinsic value.
Time to shift gears from qualitative strategy to the multi-billion-dollar quantitative question. What is the actual destination here? Boom. Let's put the bottom line right up front. Based on a standard 5-year discounted cash flow model, the base case intrinsic equity value for Lyft is estimated at exactly $28 a share. Now, this specific target relies on assuming roughly 7 to 8% compound annual growth in revenue, alongside operating margins finally expanding to a healthy 8 to 10% as their overhead scales relative to gross booking.
But as you know, valuation is never just one single number, right? It's a whole spectrum of alternate realities. The bear case sits down at $12 to $14, assuming slow growth and market share losses. Next up is the Wall Street consensus at $18 to $19, banking on just modest margin expansion. Then we have our base case of 25 to 28. And finally, the bull case stretches way up to $35 to $50 or more. But that assumes rapid margin expansion from Lyft Media and a super successful transition into an AV dispatch platform. Now, get this, with a mid-2026 market price sitting right around $15.50 to $16 a stock is hovering directly between the bear and consensus estimates. Basically, the market is pricing in a whole lot of skepticism right now.
So, what exactly pushes Lyft from that bear case all the way up to the bull case? It really comes down to three crucial variables. Number one, commercial auto insurance premiums. This is Lyft's absolute largest variable cost. If they can compress this through regulatory reforms or better fleet safety, their free cash flow just explodes. Number two, their autonomous vehicle strategy. Like we touched on, AVs are either their biggest existential threats or a wildly lucrative asset-light dispatch opportunity with software-like margins. And number three, take rate protection. Uber's massive global scale gives it a distinct cost advantage. Lyft absolutely must maintain its 25 to 30% take rate without having to overspend on crazy promotions just to keep riders and drivers using their app.
And that leads us into Section 5, Trading the Trend.
We know the fundamental value now, but how are market participants actually driving the stock day to day? Let's check the speedometer. Traders monitor these structural signals to gauge the trend direction on daily timeframes, and they primarily use moving averages. So a golden cross happens when the 50-day moving average crosses above the 200-day average. That's your structural buy signal and shows upward momentum. On the flip side, a death cross, which sounds ominous, and it kind of is when the 50-day drops below the 200-day. That's a structural sell signal. Watching these specific lines really helps traders strip out all that daily noise and see the broader turnaround trend in action.
They also rely really heavily on the 14-period Relative Strength Index, or RSI. If the RSI drops below 30, the stock is considered mathematically oversold. That means the market might have punished the stock a bit too harshly. If it rips above 70, well, it's overbought. But here's what's absolutely vital to remember. These technical levels don't just exist in a vacuum. Major technical breakouts or breakdowns on Lyft's chart tend to form super rapidly around fundamental strategic announcements. Think a surprise AV partnership, or updated guidance on those crucial insurance margins. Basically, the fundamentals fuel the engine, but the technicals show us how fast the car is moving.
Which brings us to our final massive question. Will Lyft successfully execute David Risher's mandate and become the ultimate asset-light, autonomous dispatch network? Or will their geographic concentration and heavy insurance costs make them just another casualty in the rideshare margin wars against Uber? The stakes for this turnaround are incredibly high. And honestly, that intrinsic value gap suggests a lot of upside if they can just get it right. I really hope this explainer gave you a clear roadmap of exactly what to watch for as Lyft navigates the road ahead. Keep an eye on those margins, and as always, keep learning.